Can crypto fit inside an asset allocation? The question sounds simple, but it is often pulled into two extreme stories. One story says crypto is the inevitable future of money. Another story says it is only speculation. A household does not need to settle that philosophical argument before building a practical checklist. The better question is narrower. If a household considers any exposure at all, what job would that exposure do? What risks could damage the plan? And what rules would keep the story from taking over the portfolio? This episode is educational only. It is not a recommendation to buy, sell, hold, or avoid any specific token, fund, exchange, or product. We will use 5 risk questions to decide whether crypto even deserves a place in the allocation conversation. The first question is role. What job would crypto perform in the portfolio? A real asset allocation assigns jobs. Cash supports near-term bills and emergencies. Bonds or other steadier tools may reduce volatility or provide scheduled income. Stocks or equity funds may pursue long-term growth. Insurance transfers certain catastrophic risks. A high-risk satellite position is different from a retirement core. If crypto is being considered, it needs a clearly named job. Is it a small satellite growth bet? Is it a technology exposure? Is it a speculative experiment? Or is it only fear of missing out dressed up as strategy? If the role is unclear, the allocation has no boundary. When price rises, the investor wants more. When price falls, the investor does not know whether to rebalance, hold, sell, or double down. The second question is drawdown tolerance. Crypto volatility can be far beyond what many households associate with normal saving or even broad stock market investing. Prices can move sharply because of liquidity, leverage, regulation, platform failures, hacks, narratives, rate expectations, and crowd behavior. Many people overestimate their risk tolerance during bull markets. They discover their true tolerance only after a position falls 50%, 70%, or more. The asset allocation question is not, how high could this go? The question is, if this falls hard and stays down, will the household still pay bills, fund retirement, avoid panic selling, and sleep at night? If the answer is no, the position is too large or should not exist. Where is the asset held, and who controls access? In traditional finance, banks, brokers, funds, and insurers are not risk-free, but the investor usually understands the basic account structure, statement process, and regulatory perimeter. Crypto adds different operational risks: exchanges, private keys, self-custody, seed phrases, wallet security, smart contracts, bridges, phishing, platform insolvency, withdrawal freezes, and irreversible transfers. A person may think they bought an asset, but they also bought an operating model. If the holder dies, becomes ill, loses a device, forgets a phrase, or uses an unsafe platform, the family may not be able to recover funds. Price risk is only one part of the total risk. The fourth question is liquidity, rules, and taxes. Crypto markets may trade around the clock, so they can appear highly liquid, but visible prices do not guarantee clean access to usable cash under stress. Certain tokens may have thin order books. Platforms may pause withdrawals. Banking rails may be limited. Stablecoin mechanisms, regulatory treatment, tax reporting, and exchange access may change. The key point is that liquidity is not just whether a market is open. Liquidity is whether you can safely, legally, and predictably convert the position into the money needed for real life. Money for tuition, rent, medical costs, a home down payment, payroll, or emergency reserves should not depend on a high uncertainty conversion path. The fifth question is sizing and rebalancing. If crypto is a high-risk satellite, it needs a maximum size before emotions arrive. A satellite without a cap can become the core after a price surge. A fall in position without rules can become a revenge trade after a crash. The household should decide in advance what is the maximum percentage. What happens if the position grows beyond that percentage? What happens if it falls sharply? And what money is never allowed to be used for additional purchases? Rebalancing is not about predicting the future. It is about preventing a market story from overriding the household plan. A written rule can feel boring in good markets, but it is useful when excitement or fear becomes loud. These 5 questions change the conversation. Crypto is not discussed by asking only whether the price will go up. It is examined through roll, drawdown, custody, liquidity, and sizing. If any of those answers are vague, the position is not an asset allocation decision yet. It is an unmanaged impulse. A good allocation is not a museum of every fashionable asset. It is a system where each dollar has a purpose. Emergency money, tuition money, mortgage money, retirement core capital, and speculative capital should not all face the same risk. When categories are mixed together, the household may take the wrong risk with the wrong money at the wrong time. Many people ask whether crypto is an inflation hedge. This claim needs caution. Some crypto assets have supply rules, and some narratives connect them to scarcity, currency debasement, or decentralization. But in actual portfolio experience, prices can still be driven by risk appetite, liquidity, interest rates, leverage, and speculative flows. An inflation hedge is not just an attractive story. It should help protect purchasing power when household expenses are rising. If an asset can fall deeply at the same time the household needs stability, it should not be used as a short-term spending reserve. At most, it belongs in a high uncertainty growth or satellite discussion, not in the same bucket as emergency cash. Historical return charts can also mislead. A short data window may show spectacular gains, but a high past return does not solve future risk. The investor should ask whether the risk sources are understandable, whether market structure is changed, whether taxes and trading costs are included, and whether the household can actually follow the strategy through a full cycle. A back test can look elegant while real ownership is difficult because of volatility, account access, taxes, custody mistakes, and emotional pressure. Allocation is not paper optimization. It is a behavior system that must survive future stress. A practical way to handle the topic is to create a satellite candidate zone. The core plan comes first: emergency reserves, high-interest debt management, insurance gaps, retirement savings, housing obligations, education funding, and a diversified long-term portfolio suited to the household. Only after those foundations are understood should a household discuss a high-risk satellite. Satellite money is money that can face serious loss without breaking the plan. If losing the position would delay retirement, force borrowing, affect housing, or damage essential spending, it is not satellite money. It is core money being mislabeled as speculation. The checklist can be written on one page. Is it core, satellite, experiment, or speculation? Column 2, worst case. What happens if it falls 70% and does not recover quickly? Column 3, custody. Which platform or wallet holds it, where are keys or records, and who can help if something happens? Column 4, liquidity and taxes. How would it be sold, transferred, reported, and converted into usable cash? Column 5, rule. What is the maximum size? When is it rebalanced? And what money is never used to add more? Only when the 5 columns have serious answers has the investor begun an allocation conversation. New investors face another trap: learning a little vocabulary and mistaking that for risk control. Wallets, chains, staking, airdrops, exchanges, stablecoins, ETFs, DeFi protocols, leverage, and derivatives each carry different risks. A household does not need to become a software engineer to manage money, but it does need to know what it does not know. If the source of return is unclear, custody responsibility is unclear, tax treatment is unclear, and the failure scenario is unclear, the asset should not be treated as a necessary portfolio building block. Not understanding something is not embarrassing. Putting essential money into something not understood is the danger. Priority matters. If a household has no emergency reserve, carries expensive debt, has major insurance gaps, is behind on retirement saving, or runs negative monthly cash flow, crypto usually should not be near the top of the financial list. Fear of missing out is powerful, but missing one market story is rarely as damaging as building a fragile financial base. Asset allocation is not a contest to own the newest narrative. It is a structure that lets the household grow in good years and remain intact in bad years. A high volatility asset should not be allowed to rewrite that structure. The conclusion is intentionally unsatisfying for anyone who wants a universal answer. Crypto can be discussed, but only with boundaries. Ask what job it has, how deep a drawdown can be tolerated, who controls custody, how liquidity and rules could change, and what sizing and rebalancing rules apply. If the 5 answers are clear, it may be considered as a high-risk satellite candidate. If the 5 answers are unclear, the better move is to slow down. This content is educational commentary, not investment advice, and it is not a recommendation of any crypto asset or product. The real decision depends on income, debt, taxes, regulation, time horizon, family obligations, risk capacity, and the rest of the portfolio. Stories can be exciting. Household finance needs boundaries. Information quality is another risk. Crypto narratives move quickly, and social media can make complex products look simple. Influencers, anonymous accounts, trading groups, referral links, and promotional research may have incentives that are not aligned with the household. A serious allocation process asks where the information came from, who benefits if you trade, what failure cases are missing, and whether the argument still makes sense without a rising price chart. If the research source is really marketing, the risk is not only market risk, it is decision environment risk. Tax records and documentation also matter. Purchases, sales, swaps, staking income, airdrops, transfers, and exchange movement can create reporting complexity. Many investors track price but fail to track cost basis, transaction history, wallet location, or proof of funds. A household asset should be understandable to a spouse, executor, accountant, or future version of yourself. If an asset cannot be explained, located, valued, taxed, and exited with reasonable confidence, it should not occupy an important share of the plan. Finally, separate a lucky trade from durable investment skill. A rising market can make anyone feel disciplined. A missed rally can make anyone feel desperate. Neither emotion is an allocation rule. The skill is remembering the cap when prices surge, remembering the written thesis when prices collapse, and returning to the household balance sheet when online narratives become loud. If crypto has a role, it should be a contained role. It should not become the narrator of the entire financial plan.